Hello, everyone, and welcome to the November Real Talk About Real Estate. My name is Michelle, and I am the marketing lead for the ABR designation. Today, I'm joined by Cynthia DeLuca, who is a speaker, author, mentor, and coach. This month's Real Talk is all about short sales and foreclosures. As a reminder, we are live, so if you have any questions or just want to say hi, leave us a like or a comment on the video. Cynthia, could you please start by sharing your experience with foreclosures?
Sure, absolutely. We went through this great recession back in, 2008, 2009 was the peak of it. But during that time, I had a real estate brokerage and had to make that shift and pivot to kind of survive. And being from Central Florida, we were one of the hardest hit areas with foreclosures and short sales. And so we survived by making that pivot and really focusing our business on those foreclosures and short sales. So I've sold over 1,500 foreclosures in one 12-month span. Not something super proud of, because it's not a great market if we have that many foreclosures and short sales. But
Right.
It really taught me to have some passion and my goal is to really help fellow realtors who maybe have not been through a cycle of a downturn or a change in the market to really kind of focus on what can we do to prepare and what can we do to help our buyers, buy these types of properties. So that's what we're hoping we'll cover today and then some.
Yeah, that sounds great. Awesome. So I guess, what's the current market looking like? Do we have a lot of foreclosures across the board? Are they clustered based on region?
Yeah, the interesting thing about the foreclosure market right now, it's slim to none. I mean, in most places, there's really not a huge amount. So again, it's like, why are we talking about this? Well, I think we have to look at the current times. Obviously, everything we've been through in the past 18 months with COVID and all of the economic changes that has brought on really has changed a lot of landscape in looking to the future. And so a lot of people, a lot of smart people and investors and economists are looking and saying, is the next fall or crash about to happen? And I don't really know the answer. I don't really think anybody knows the answer. All we can do is look at what's happening and look at history and kind of decide from there. So I've had a lot of realtors say to me, oh, it's different. It's never going to crash like it did back then. And, prices are going up so quickly. And, for most parts of the country, that's the case. Prices are going up. There's been a lot of demand. We've seen very limited inventory. But when the fall happened of 2006, 2007, when it really started to happen, I'm going to show you a chart quickly here you can see how we were just going up and up and up and life was great. I mean, for a good 5-6 year span, it was just going up like crazy, more steep than what we've seen in the past 18 months. But then you can see it just kind of tailors off here. I call it a roller coaster ride. It's like, you're going to the top of the roller coaster and then all of a sudden you kind of get to the top and you level off and then you are on this downward fall that just felt like it was forever. And are we ever going to stop? And so, thankfully we did, kind of bottom out and then start climbing up around 2015. And we've had some good years since 2015. And so, there's a little bit of difference and a little bit of similarity with what happened during the Great Recession. Let's talk about the differences. Interest rates are really low, much lower than they were then. I don't necessarily think that the economists are not thinking this will be a real estate crash, right? And so in a real estate crash, we've got, the challenges of the Great Recession of 2009, 2008 was really focused around real estate. And so there are some differences in this one where maybe the economy is hindering on some other issues, right? With COVID and closing and, our country and the world and the economy system and whatnot. But there are also some similarities. And so getting people to understand kind of the background of what's happening behind the scenes, right? The positives we have low interest rates. We have a lot of demand right now. We have, buyers. It's been challenging for some of our buyers because they're, having to compete with multiple offers and things like that. A lot of that is starting to mellow out in most parts of the country, but it's still, challenging with limited supply. And so looking ahead, there's no question the market, the real estate economy is going to change. I think the question is when. And so we want to be prepared for that, and we want to prepare our customers for that. So some of the interesting things about this time right now in our lives, of course, we've been through COVID and we've been through these economic issues. We've got shortages right now with getting goods and supplies into our country. And so, it's causing this a lot of things are causing massive inflation. But when it comes to the real estate market, even just before COVID really hit the United States, in December of 2019, the federal government started basically what I call manipulating the real estate economy by adding in, they're buying all these mortgage-backed securities. And so when buyers go and get loans at banks and they kind of package it all together, these banks, they resell it because they need to free up that money to go create new loans. And so they sell it on the secondary market. And these mortgage-backed securities, typically investors buy them. It's another way for an investor to invest and make some money. Well, the mortgage-backed securities, when COVID was first in talks and kind of is it coming our way, all the investors went, whoa, we don't want to get into another great recession, right? They didn't want to be holding all that responsibility if the real estate economy collapsed. And so when you have supply like that, but there's no demand, that would cause some really not good consequences, right? Interest rates would go through the roof, and there would be it would have stopped the real estate world. And so the Federal Reserve recognized that and said, okay, we'll be the buyer, right? We'll come in and we'll buy these mortgage-backed securities. And so they now own 1 out of every 3 mortgages in the United States. The federal government does. That's a lot. They have bought a lot of these since then. And so that's what when they're talking about tapering back in the next couple of months, that's what they're talking about doing, is kind of slowing that process of buying these mortgage-backed securities, hoping that investors will have the faith and the comfort to come back in and buy. And so that's an important piece to watch to see what does happen with our foreclosure and short sale market. And the other piece of that is this forbearance issue that people have had the opportunity to take advantage of really for the past 18 months. And so forbearance is the borrower, the current owner or seller doesn't have to make their payments. They kind of push that off because the whole world shut down, right? Economically speaking. And so now we're 18 months later, and we're seeing all these reports about people exiting forbearance, which sounds like such good news. But we still have about a third of those loans are still in forbearance from when they peaked. We have over 1 million loans still in forbearance. The news they're not necessarily talking about is how they're exiting forbearance. The majority of them, the largest percentage, are leaving in what's called a loan deferral process. And what that means is they're taking all that past due and chunking it onto the end of the loan and saying, okay, just start making your payments again, right? And so we're going to see some consequences from that, where people are not necessarily economically back on their feet. They're just kind of picking back up where they left off and are starting, but still owe all that money and all those fees. I've seen that already come up in some of my transactions as problems where the seller doesn't realize this is actually how much their payoff is. They're thinking it's a different amount, and now they owe a lot more. So I think that's some of the problems we might see coming ahead, where people say short sales aren't possible because our prices are so high. Maybe, right? Maybe not. I don't know. When you add in those forbearance issues, and then they, think about, well, we're not going to see the amount of foreclosures and whatnot. Well, within 1 week of the moratoriums expiring, we saw in Florida, our foreclosure filings increased by over 37%. And it's doubled literally every week since then. And so, of course, different parts of the country are going to be different. Right. But it is something that we need to watch, because it's possible at some point in time, whether it's in 2022 or 2023, who knows? But we need to get ready, and we need to get our buyers prepared and kind of understand that process. This cycle is also very different from 2007 and 8 and 9. And so it's a different, the banks have figured out a lot. They've learned a lot from the Great Recession. So a lot of the processes are different. So we want to get everybody.
Are they better? Are they better?
I think they're better because when, we had such a mass amount of challenges of people that just couldn't pay and stopped paying their mortgage back in, 2000, really it started in 2007, 2008 and so on. that the banks didn't know how to handle it. They'd always had foreclosures. They'd always really done short sales, not a huge amount of them though. And so now all of a sudden, when you have so many properties that are distressed like that, it was very challenging for them to figure this out on a big scale. So yeah, we have some things in place with Fannie Mae and Freddie Mac, and the HUD with FHA and VA, and a lot of those big government-backed type of entities have rules and regulations and processes in place, which will be good if we ever see an increase in our short sale market, because they've really figured out the process for short sales. And then, of course, with the foreclosures, they saw the good and the bad that how they handled some of those foreclosures, and they really streamlined that process a lot as well. In the beginning of that recession, I mean, it was kind of all hands off. It's all up to the realtor to handle everything. We were dealing with the liens on the properties, code enforcement violations, unpaid utility bills, trying to straighten all this up so that our buyers could buy the house and move in.
Yeah.
And now they've streamlined most of that. Almost all of the lenders now will take care of all of that before the property goes on the market, which is a huge advantage. Yeah. So for the buyer's sake, it's really, it's a lot better now to buy a foreclosure than it was, 12, 14 years ago. But I will say too, on one note, a lot of people have this idea in their mind that buyers should not buy a foreclosure or a short sale if they're an owner occupant. In other words, they think that's for investors. That's, investors should buy it. They're going to get, these properties that are in horrible condition, and some of them are, but some of them are livable, right? Move right in. There are some of them. And so they kind of tell their buyer, you probably don't want to waste your time with that. And so one of the things that Congress has done is they have legislation in for, again, these GSEs like Fannie and Freddie, HUD and VA, that they all have regulations that they have to sell a certain percentage of their properties to owner occupants. And so the good news is a lot of these lenders now, or the investor that has the REO, the foreclosure, a lot of them now give a time frame up front. Maybe it's 10 days, sometimes it's 7, sometimes it's 14, for owner occupants only. So they really give a preference for owner occupant buyers, which is good to know. And you want to check with that foreclosure, if you're that buyer's agent, to see, are they going to offer that? Does my owner occupant buyer have an advantage to get into this property? So.
Yeah. I mean, I was going to ask, what are some things that, buyer's agents can do to get their buyer's offers accepted in a foreclosure transaction. So I think that's definitely a great start, is to find out, if there's any cap on or preference for owner occupancy in those properties.
Yeah. And again, it does kind of depend on who that lender is that owns the property. So when they foreclose on that property and they take the property back, speaking of these foreclosures, it really depends on who you're dealing with. If you're dealing with the direct lender, like a Bank of America or, one of the big banks, they may have different regulations. But if the loan is underwritten through Fannie, Freddie, the GSEs, or again, HUD for FHA, if it was an FHA property, they do, and HUD and FHA and VA give precedence. No, they give preference. That's the word. Preference to others buying, utilizing that financing. And the same thing happens in a short sale situation. The seller and the buyer actually have some incentives, like with FHA. If the seller had an FHA property and the buyer is coming in with a new FHA loan, they do offer them some additional incentives for that. So again, it's really important for the buyer's agent to feel comfortable asking some of these questions or looking it up. Back to the foreclosures, when we're talking about the owner or the investor, by looking up, if you're in a state with public records, you can look up and see who that owner is. And again, if it's Fannie, Freddie, HUD, VA, they're going to give some sort of preference typically to that owner occupant. There is no guarantee though, if it's,
right,
any of the other direct banks. Basically, you just don't know what you're getting into with that, but you certainly could always ask or look for that in the remarks in the MLS if that property is in the MLS, to utilize and see, are they offering anything specifically for owner occupants? So definitely.
That's really interesting.
Yeah. And some of those properties like HUD, right? HUD was originally an FHA loan. then let's say the borrower defaulted and it became a foreclosure. So in that instance, what HUD does is if the property, they do an inspection and they do a full appraisal before the property goes on the market. And so if they go in and determine that the property is insurable, is what they call it, meaning it can get FHA insurance, it can pass FHA standards, then they will also give some incentives and preference for buyers who are purchasing with FHA financing as a foreclosure. So again, a lot of people think owner occupants should steer clear of those properties, but not necessarily. That used to be the case, but that's changed quite a bit. So really a lot of stuff has changed since the Great Recession. So
yeah, that's really interesting.
Yeah. And let me touch on short sales for a moment as well. So with short sales, again, we might not see a larger increase. And really short sales mean that the property owner owes more than what the property is worth. So in other words, what they could sell it for. If they owe $400,000, but they could only sell it for $350 because that's what the market value is, then they're upside down in their property. Okay. So a ton of people say, oh, that's not going to happen. There's, let me tell you, there are billions and billions of dollars upside down right now in real estate across the country. CoreLogic does a report every quarter and they put it out. And we have plenty of people in the United States that are upside down in their property. And the third quarter of 2021, which just ended, we saw a massive amount of people tapping into their equity and pulling that out. And so my banker is the one that even brought that to my attention, that said, we've got to watch this because the banks are now starting to see, whoa, should we pull back a little bit? Should we be a little bit more conservative? Because people are getting themselves in that position again where they're getting upside down. And so a short sale is a potential, possibility. And probably most anybody could look in their local market and find at least one or a handful, depending on how big your market is. You can find some short sales in the distant area that are on the market now, that are selling, that have consistently sold since that last recession. And before then, I did my first short sale in like 2000 or 2001. So they've been around for a long time. We just don't really hear about them as much until it becomes the news every day. Just like forbearance, right? Forbearance wasn't really a topic that many people had heard about, but they created the forbearance issue so that people could stay in their homes and we not go into a devastating foreclosure market. So we'll have to watch and see what's going to happen with the Fed and how they're going to, taper those things off and whatnot. But overall, buyers can help, get that property. With foreclosures and with short sales, they are required to be on the market in the multiple listing service. So they're going to be in your MLS, set up safe searches, things like that. They'll pop up in there. They're not like hidden type of listings. They will be there. So, all right. So I see the question that just popped in.
Chris has a question.
Okay. So the question is, why are reverse mortgage foreclosures not negotiable for buyers? Are you seeing a lot of these as foreclosures? There's basically two different types of reverse mortgages. There's kind of the old fashioned type of, or the original type of reverse mortgages, and then the newer type of reverse mortgages, which are all FHA financing. And I can tell you that I'm not the expert on the origination of these types of loans, but I can tell you that I've dealt with them through foreclosures and estates when people have passed away. And so every state's a little bit different in how they handle it. But with reverse mortgages, the main idea is it's reverse. That's why it's called a reverse mortgage, of when a borrower takes a loan out from a lender, right? The borrower borrows $400,000 to buy the house, and they make small payments to the lender until it's paid off in 30 years or 15 years or whatever that term is. A reverse mortgage is the exact opposite. So now the lender, think of it this way, is buying the property back from the homeowner and paying that homeowner small payments or larger payments every month until 10 years is up or 15 years is up or whatever. And so once that term is up, or once they're vested so far in, the bank technically owns the property or the majority of the property. And so a lot of owners get confused and say, but it's my house. Well, not necessarily anymore, because the bank has paid you for it now for the past 15 years. And so with reverse mortgages, they can be very challenging. I had a situation with a seller who wanted to sell their house, and they got the notice that their reverse mortgage was done. They had 30 days to vacate a 3-acre property that they had lived in for 45 years. It was
Oh my
devastating to the
goodness.
family. And none of the
Oh my
adult children
goodness.
knew that the parents had done this. And so all of a sudden, they just don't think about the long term of the consequences. So to answer your question about why they're not negotiable for buyers is really because the seller doesn't own the property. For a lack
Mhm.
of better terms, that's probably the best way I can explain it, is the seller has kind of signed that right over to the bank, and the bank is making them those payments to help supplement their income. There's a lot of benefit there as to why they're doing that. But okay, so buyers, right? Again, that property is going to be in the MLS. So when you see, these properties, whether they're foreclosures or short sales, and you kind of know in advance because the grass is really tall, or they're not being cared for. They post the big notices on the door. It's kind of obvious that it's going to be some type of distressed property, maybe coming up. And so you might have a buyer that calls you that says, "Hey, I drove by this house. I'd like to look at it, get the information." You will spin a lot of wheels, right, looking for this information, because the property is not ready for whatever reason to go on the market, or they might not even actually know how much the property is going to be listed for. So when we're assigned a new listing on the foreclosure side of things as a listing brokerage, we're assigned to kind of go look at that property, take photos, do all of this. We don't know what that property is going to be listed at that time either. So we're starting the process of the cleanup and getting it ready for the market. But we know once basically everybody else knows. So we get the listing agreement with the price filled out and all of that, and we have to have it on the market in the MLS within 24 to 48 hours. And so
Wow.
yeah, it's a very quick turnaround process, and they
Yeah.
they they watch you like crazy. You have to submit proof of everything. So again, once it comes on
Mhm.
the market, it's kind of everyone's going to know about it at about the same time. Now, the process with the foreclosures is, the buyer can get in and make the offer, but they need to help them kind of get that offer accepted. They need to have all their ducks in a row up front. You've got to have that pre-approval letter or proof of funds, whichever, which we know is vital with all buyers, but they are not going to play around when it comes to an REO. The proof of funds has to match the buyer's name in most instances. So if they're getting like hard money financing, or they're borrowing all the cash from their parents or a family member or somebody else, that's going to be a little bit challenging explaining that to the REO company, because they want to see that the proof of funds match the buyer's name
Mhm.
and everything is there. If the buyer's purchasing in a corporation, they want to see the corporation documents with the offer. You need to make sure you're communicating as a buyer's agent everything. Think of any question a seller would have about who is this buyer, and do they have the ability to buy, and will they close? Because the asset manager wants to make sure that property is going to close. So make sure you get all that upfront from the buyer before you even waste your time writing an offer. Then you're typically going to write your standard offer. Most of them are as is, because once the property's gone on the market, the lender has already done updates and repairs, or whatever they're going to do. If anything, they've already done it. And so typically they are sold as is, which means you get what you get what you get. Sometimes that's
Right.
leaks and other issues, but sometimes they are in pretty good shape. And so the other thing is, so you write the offer, right? Now, once you've negotiated back and forth, typically not negotiating on weekends because they kind of have banking hours. So no weekends and holidays type stuff. But once you receive kind of let's say you get that agreement together and both buyer and seller are agreed upon, then the bank will create what's called addendums. And these addendums are 15 pages, 18 pages long of stuff that changes your primary contract, changes a lot of the terms and conditions.
Mhm.
So you need to make sure that the buyer is prepared to understand in the REO transaction, it's kind of take it or leave it. The bank is the one setting the rules, the entire process. And you either have to agree with those rules or buy a different property. So they will not
Mhm.
allow the buyer to make any changes whatsoever to those addendums. So it's important for the buyer to get the addendums, to make sure they have time to read through them, make sure they understand them, but they will not allow them to cross things out, make changes, whatever. It's kind of a take it or leave it type of document.
Wow.
So the buyer needs to be prepared for that. And they need to be prepared for an emotionless transaction. The sellers don't care that they really, really want this house, or that they really, whatever. They don't care about any of that stuff. It's all a numbers game to them of liquidating the
Right.
property for the most amount of money in the shortest amount of time. Those are kind of some of their requirements. So So the disclosures is another big question I get from buyer's agents. Where's if sellers disclosures are required in your state or whatever types of disclosures, where are those? Or they need to send those to me. They're built into those addendums. So they may not look just like the ones you're used to, but they're in there. Like they've met the requirements of the law, of whatever your state says, and they've kind of put the disclosure in there. And for lack of better terms, it might say something like, we foreclosed on this process through a legal process. We don't know anything about the property. Do your own inspections. That's basically what they say, but it takes them like 3 pages to say that. So those disclosures are kind of covered in there. So you make the offer, then the addendums come. Make sure that you're clear and understand the difference between FHA, VA, cash transactions, conventional financing, right? If you're not as familiar with that as a buyer's agent, sit down and talk to a lender. But from the seller's perspective, it's important to know the differences of those. And again, what the condition is going to need to be in for that type of property. And then again, getting to know kind of who that lender or owner is. So, all right, how do you get your offer accepted? That might be another question that maybe a buyer's agent has, is what do you do to get that offer accepted? I have seen in all of my years of REO transactions, there is one single thing that I have seen more successful than anything at getting an offer accepted. Even when the offer, if there's multiple offers, even when the offer is lower than other offers, I have seen time and time again that asset managers take the offer with the highest earnest money deposit. And I mean highest as in not $1,000, not $1,500, not cheaping out, like 10%. Or something equivalent, whatever your buyer is comfortable with, but a significant earnest money deposit, because that shows the asset manager you are going to close this transaction, right? You have that, your checkbook in the game, and you are definitely going to be more on top of getting this closed. You're not going to walk away as easily, and that's really important for them. So even if your buyer cannot raise their offer price, raise their earnest money deposit, right? And then in the end, they're, if they buy it and they're happy, they're still working out with that same price. The least amount of contingencies possible. They will not take an offer that requires the buyer to sell their current house or something like that. They're not going to take that type of offer. So they need to put in the least amount of conditions and contingencies as possible. And as I mentioned, they're typically sold as is. So there's they don't like to do repair negotiations or other things like that. It's not pretty typical to see that. Sometimes in rare cases, I've seen Fannie Mae and I've seen VA do that, but typically that is not something that happens. So expect that that's not going to take place. The other thing is make sure that you give the shortest time possible to close the transaction. So as a buyer's agent, I'm typically asking the buyer and the lender, if there's a lender, how comfortable are you with your closing date? When do you feel the soonest is that you can close? But you also want to give enough time to make sure you can get that transaction closed. So the asset manager and the short sale lender, the loss mitigator, is going to want to see a quicker closing. They don't want it to take forever. But if you put too short of a time frame, let's say you put 20 days and it's financing, you put too short of a time frame, the challenge that comes in there is something called a per diem charge. And a per diem means per day. This is very common in foreclosure transactions where basically, if you have to go back to the bank and say, we need 5 additional days, they say, fine, you can have it, but the buyer's got to pay for it, and they have to pay for it up front. And so the buyer has to stroke a check for, I've seen it from $50 a day to $250 a day. And so it can get very expensive. So you want to make sure you kind of find that sweet spot in the middle of the closing date where it's not too far ahead, but it's not too short of a time frame either. So,
right. Wow. That was a ton of information. I hope that, Chris, answered your question. I hope anyone who's watching, that was a good overview for you, because that was certainly like a very comprehensive overview of buyer's agents, what you need to know about short sales and foreclosures. I do want to mention also, go ahead, Cynthia.
No, I was just going to say, if you don't mind me plugging, because, this is such a short time frame and there is so much information about this. I'm going to be selfish and plug an ABR elective called the SFR, the short sale and foreclosure resource certification. So if you have not taken that class, or if you have not taken that class in the last year and a half or 2 years, everything has changed since COVID. I would highly encourage you to look for that, the SFR certification course one day, and really dive into that to understand a lot more about the foreclosure and short sale market.
Yeah, thank you for mentioning that, Cynthia. And I can drop in a link too. You can find where you can take that course, either but like in a classroom setting. I was going to say live. Just depends on the association. Things are kind of tricky right now because of COVID, but also it's Designation Awareness Month, which is really exciting, which means that all designation and certification online courses are 20% off through Center for Realtor Development. And you can find all those online courses at onlinelearning.realtor. So if you want to take the SFR online course, great time to do it in November because it's 20% off. So if you're looking for other resources as well, we have quite a few blog posts on homebuying.realtor that cover, short sales, foreclosures, distressed properties, things that Cynthia mentioned. So be sure to check out homebuying.realtor as well. And then also, this Facebook group, if you want to ask Cynthia a question, she's in the group. If you are wondering, from other agents in your area, what they're seeing with foreclosures, great place to ask other buyers reps because they know. So, all right. So I don't see any other questions. So thank you, everyone.
One more quick comment.
Go ahead, Cynthia.
As realtor to realtors, please prepare, because again, it's not a question of if the economy is ever going to change, it's when, and we don't know when that is. So just make sure you have a little bit of a savings account and, some backup there. So thank you, Michelle.
Makes sense. No, thank you. And thank you everyone for joining us. Thank you, Cynthia. I hope you learned a lot about short sales and foreclosures in today's market. Please join us next month on December 15th when Shannon Buss returns to share her secrets on how to master the home buyer consultation. I hope to see everyone watching at booth 1650 at the Realtors Conference and Expo and at the ABR, SRES, and Green Networking and Awards reception in San Diego. We'll see everyone else right back here in the ABR Networking and Referrals Facebook group next month. Bye, everyone.